One of the most important aspects of any financial analysis is profitability. To determine a company's profitability, one can look at net income, but that tells only a portion of the story. It does not reveal how efficiently and effectively those profits were generated. Each of the ratios shown on this slide reveals something different about a company's income, and they are best used in tandem so that a broad understanding of a company's profitability can be obtained. Creditors are concerned with profitability because it indicates an ability to make required principal and interest payments. Stockholders are very interested in profitability because of related increases in stock prices or dividends paid to shareholders. Managers are also concerned with profitability as it is often related to performance evaluations and tangible rewards from bonus payments and other incentive compensation plans. The profit margin ratio compares net income to net sales and measures the ability of a company to generate profits from sales. A higher ratio indicates a greater ability to generate profits from sales. So now going back to Best Buy, their 2010 profit margin is 2.5%, which means that they generated 2.5 cents of profit for every dollar of sales. And so remember, we're comparing them year over year, so we see that that went down from 2009 and to a competitor, H.H. Gregg. So they're doing better than their competitor, and so we see the competitor also went down. So it may not just be something that's happening in Best Buy in 2010. The return on equity ratio compares net income to the average balance in stockholders' equity during the year. So that shows how effectively a company uses the equity provided by stockholders during the year to generate additional equity for its owners. So stockholders naturally want this ratio to be as high as possible. So now looking at Best Buy again, in 2010, their ratio or return on equity ratio was 17.9%, which again was down from 2009, but it's better than H.H. Gregg. The return on assets ratio compares net income to average total assets during the year, representing a company's ability to generate profits from its entire resource base and not just those resources that were provided by owners. So like the return on equity, investors would like to see this ratio as high as possible. But here again, for Best Buy, this ratio is declining. And in this case, this ratio, return on assets, is lower for Best Buy than for H.H. Gregg. But if you look at the trend, that has been the case in the last 3 years. Earnings per share compares a company's net income to the average number of shares of common stock outstanding during the year. The ratio represents the return on each share of stock owned by an investor. So a company can boost its earnings per share in one of two ways: increasing profitability and reducing outstanding shares. So let's take a look at Best Buy again. They've got earnings per share of $3.15, which stayed about fairly stable from 2009, and it's much higher than H.H. Gregg. So Best Buy was able to maintain its earnings per share because it reduced the number of shares of stock outstanding from 419 to 393. Remember, they had two ways of maintaining or increasing earnings per share, and that was by changing the number of shares outstanding and changing profitability or increasing profitability. The price to earnings ratio compares net income to the current market price of the company's common stock and provides an indication of investor perceptions of the company. In other words, a price to earnings ratio of 10 means that investors are willing to pay 10 times current earnings per share to buy just one share of stock. A higher price to earnings ratio generally indicates that investors are more optimistic about the future prospects of a company. A lower ratio generally indicates that investors are less optimistic about the company's future. However, from an investing point of view, some investors like to see low PE ratios if they're sure that it's a solid company, because that means that the market hasn't yet caught on that it's a good company, and so the price is not very high just yet. So getting back to Best Buy, their PE ratio is falling and it's less than H.H. Gregg. So let's summarize the overall profitability of Best Buy. So based on those 5 ratios that we looked at, it's clear that Best Buy is profitable, but its profitability, depending on which ratio you look at, has either stayed the same or declined from the prior year. So they might want to take a look at this trend, especially in an industry that depends on consumer spending.